Imagine this scenario. It is 9:15 a.m. on a Wednesday morning, January 28, 2026. You are sitting in a 48-floor office in a skyscraper in central Hong Kong. The air is filled with the scent of expensive espresso, and outside the window lies the gray-blue surface of Victoria Harbor. As the chief investment officer of a family office managing $300 billion in assets, there are few things left in this world that can make you raise an eyebrow. But suddenly, the encrypted phone on your desk vibrates. The name flashing on the screen is your most important client, the patriarch of a family controlling a massive palm oil and shipping empire in Southeast Asia. Usually, he only asks about the progress of acquisitions or his grandson's trust fund. But today, his voice sounds different. The tone is cold and sharp, like a freshly sharpened scalpel. He tells you, "I want you to take 20% of the cash in our accounts immediately and convert it all into physical gold. I don't want ETFs, and I don't want paper gold contracts. I want metal I can touch." You glance up at the Bloomberg terminal. Gold prices are flashing at $5,111. Silver is oscillating at a high of $115, while the US dollar index is teetering like a drunkard. You suddenly realize that this isn't just an isolated phone call. Over the past 18 months, while retail investors on Twitter were arguing red-faced about whether Nvidia could break $200 or discussing which cryptocurrency would make them rich overnight, the true old money, those family fortunes that survived the hyperinflation of the Weimar Republic, witnessed the collapse of empires, and have been passed down for a century, have quietly pushed their lifeboats into the sea. This isn't just about making a profit on the spread. For them, this is not an investment. It is survival. Today we won't talk about candlestick charts. Instead, we will deeply analyze why the wealthiest people on this planet are abandoning the paper money empires they built with their own hands. Let's first forget the nonsense about supply and demand balance found in economics textbooks. We need to fix our eyes on a number that sends shivers down the spines of all Wall Street analysts. 1,045 tons. This is the global total of gold purchased by central banks in 2025. If you have no concept of this in your mind, imagine this. It is equivalent to about 200 African elephants made entirely of pure gold. They are lining up, silently walking into heavily guarded underground vaults during this year full of uncertainty. But what is truly terrifying is not the total amount, but the timing of their purchases. In traditional financial logic, when the price of an asset hits a historical high, normal buyers hold back and wait and see. But today's central bank governors, a group of bureaucrats usually known for being the most conservative, sluggish, and focused on price sensitivity, are chasing highs just like panicked retail investors. In the third quarter of 2025, even though gold prices had already broken through the ceiling, their purchase volume still skyrocketed by 28%. This completely defies business logic, unless you understand that what they are buying is not a commodity at all, but insurance. Look back at history, and you will see how absurd this contrast is. In the late 90s, for the sake of so-called asset modernization, the Bank of England sold off half its gold reserves at the lowest point in gold prices. That foolish decision is still mocked today as Brown's Bottom, named after the then Chancellor of the Exchequer, Gordon Brown. Back then, gold was ridiculed as a barbarous relic. But today, the wind has completely changed direction. Adam Glapiński, the governor of the National Bank of Poland, has laid his cards on the table. He frantically bought gold, pushing national reserves to 28%, citing a reason that is chilling. He said that gold is the only safe investment for national reserves. Even if someone cuts the power to the global financial system, it will still retain value. Please note the phrase, "cut the power." This is no longer a financial term. It is a war term. As for that well-known Eastern superpower, official data says they bought 401 tons. But anyone who has been in this industry for a long time knows that this is like asking a professional bodybuilder how much protein powder he eats a day. Whatever number he tells you, you have to multiply it. Industry experts estimate, by tracking refinery data and trade flows, that the Central Bank of China may have actually hoarded over 5,000 tons. Moreover, this is a one-way street. It is simply the gold version of Hotel California. You can buy the gold in any time, but don't expect even an ounce to flow out of the border. Why have these big players suddenly become so paranoid? To understand this collective panic, we must turn the clock back to the day that changed the geopolitical landscape. February 26, 2022. That day, the G7 nations made an unprecedented decision to freeze $300 billion of the Russian central bank's foreign exchange reserves. For ordinary people drinking coffee at Starbucks, this was just a number in the news headlines. But for those oil tycoons holding billions in cash, dictators or central bank governors in Singapore or Saudi Arabia, this was simply the climax scene of a horror movie. Imagine you are the administrator of a country, and you hold hundreds of billions of dollars in U.S. Treasury bonds. For the past 50 years, the promise from the Western world to you was, we may disagree politically, we may argue, and we may even fight proxy wars, but financially, your money is sacred and inviolable. However, in that second, this contract was torn to shreds. The world suddenly realized, even if you are a superpower with 6,000 nuclear warheads, as long as you anger the people who control financial sovereignty, your national piggy bank can be wiped out in an instant. It's like suddenly discovering that your landlord has a master key, and as long as he thinks you're behaving badly, he can lock you out and confiscate all your furniture at any time. In that moment, trust collapsed. This isn't just simple de-dollarization. This is a defensive rebellion by the Global South. This is why we are seeing multilateral central bank digital currency projects like mBridge accelerating, why Saudi Arabia has started accepting RMB for oil settlements, and why India is pushing for rupee trade. They aren't looking for a replacement for the dollar, because the euro carries the same risks, and the yen is also a Western ally. They are looking for something that requires no one's signature, no one's endorsement, and cannot be frozen by any politician with the push of a button. Gold needs no password, no server, and doesn't need to please the US president. It just sits there, shining, silent, heavy, but absolutely honest. If central banks are the giant whales in the deep sea, then the waves have now transmitted to the shallow waters. Let's turn our attention to the most ordinary American suburbs. Walk into a Costco, and between the mounds of mayonnaise buckets, cheap rotisserie chickens, and 50-gallon jugs of laundry detergent, you'll find a strange phenomenon. People are frantically buying gold bars. This is no longer a story about a few doomsday preppers digging holes in their backyards to bury gold coins. This is the collective behavior of middle-class aunties living in townhouses and driving Toyota SUVs. According to Wells Fargo data, Costco sells $200 million worth of gold bars every month. These budget-conscious consumers discovered that buying gold bars with a Costco credit card gets them 2% cash back, becoming the most ironic hack of 2026. Why? Because although ordinary people don't understand the financial repression theory of macroeconomics, they have intuition. They go to the supermarket and find that $100 used to fill a shopping cart, but now it only buys 2 bags of items. They watch house prices rise and the stock market rise, but the wages in their hands are shrinking like ice cubes. They feel a deep sense of being looted. For them, buying gold bars is not to get rich, but a form of financial self-defense. On the other side of the ocean, young people in China are playing this game with a twist. They are showing off gold beans, tiny gold grains weighing only 1 gram on social media. These Gen Zers, who don't buy houses, don't get married, or even date, have seen through the essence earlier than their parents. Real estate might rot unfinished. P2P lending might abscond with money. Mutual funds might get halved, but gold is always gold. This is a consensus that transcends borders and classes. When paper money becomes as untrustworthy as waste paper, people instinctively want to grab onto something tangible. If gold is the king sitting on the throne, then silver is the crazy prince just released from the asylum, ready to slaughter everyone with a sharp blade. When you see the price of silver skyrocketing from $30 all the way to the current $115, nearly tripling, you might think it's a bubble. But if you dig deeper, you will find that the story of silver is sexier and more brutal than that of gold. Because silver is not just currency, it is the blood of technology. Are you listening? Every high-end NVIDIA GPU chip, every AI data center that Microsoft and Google are frantically building needs silver. Silver is the most conductive metal on Earth, bar none. Without silver, AI cannot run. Without silver, there are no efficient solar panels and no electric vehicles filling the streets. And on the supply side, we are in big trouble. This is a geological fact rarely talked about. Silver is extremely special because most of it isn't mined specifically. It is a byproduct of mining copper, lead, and zinc. This means supply is inelastic. Even if the price of silver shoots to the sky, mining companies can't suddenly conjure up more silver mines, unless they mine tons of copper just for that little bit of silver, which makes no economic sense. The result is that the 2026 silver market is seeing the phrase that gives all procurement managers nightmares: priced but unavailable. The current industrial shortage is as high as 6,000 tons. You want to buy? Sorry, no stock. Go wait in line. Apple is scrambling for it. Tesla is scrambling for it. Defense companies are scrambling for it. Silver has transformed from a poor man's gold into a strategic resource that must be fought for. This is no longer financial speculation. This is a hard shortage in the physical world. Let's step away from finance for a moment and talk about geology. Even if everyone in the world wakes up tomorrow morning and decides not to hate the dollar anymore, the prices of gold and silver might still rise. Why? Because we have drunk all the easy milkshakes. Imagine the Earth as a giant milkshake cup. Over the past 150 years, starting from the California gold rush in 1849, humanity has been using a giant straw to greedily suck up the shallow gold on the surface. We found nuggets in riverbeds and hollowed out the massive gold veins of South Africa. Now, a sputtering sound is coming from the straw. That is the sound of hitting the bottom. South Africa used to be the Saudi Arabia of the gold world, producing 1,000 tons of gold in 1970. Today, less than 100 tons. Existing mines are getting deeper, and ore grades are getting lower. Before, you could refine 10 grams of gold from a ton of earth. Now, if miners dig up a ton of earth and find 1 gram of gold, they pop champagne to celebrate. Add to that the so-called jurisdictional risk. You want to open a new mine in a politically stable place like Canada or Australia now? Good luck. Environmental approval alone takes 10 years. And in those places that don't need approval, like Congo or Venezuela, Your mine might be confiscated by a local warlord tomorrow. This is a perfect storm. Demand is exploding historically, while supply has hit a geological wall. In the past, your financial advisor would wear a decent suit and tell you a seemingly perfect formula. Put 60% of your money in stocks and 40% in bonds. Then you could sleep soundly and wait to retire to Florida to sunbathe. The truth now is, that strategy is dead. The body is already cold. It died once in 2022, which was the worst year since the Great Depression. And now, with inflation sticking like glue and refusing to leave, bonds are no longer a safe haven. They have become a guaranteed loss. Behind this is a macro concept called fiscal dominance. Simply put, the Federal Reserve has lost control. If they raise interest rates to fight inflation, the U.S. government will go bankrupt because it cannot pay the interest on national debt. If they cut rates to save the government, inflation will spiral skywards. In this deadlock, bondholders are the destined losers. If the 10-year Treasury bond you buy gives you 4% interest, but the real inflation rate is 8%, then you are not just standing still, you are getting poorer at a rate of 4% per year. This is called risk-free return, turning into return-free risk. The old money saw through this trick long ago. The Rothschild family, the Norwegian sovereign wealth fund, they are swapping that 40% safety cushion originally belonging to bonds for gold. It's like throwing a rock into a bathtub full of water. The bond market is the ocean, with a volume of tens of trillions, while the gold market, by comparison, is just a small pond. As long as these giants move even 1% of their funds from bonds to gold, the small pond of gold will surge with monstrous waves and overflow its banks. Finally, I want to tell you a story to end today's topic. Imagine it is 2026, and the global financial system is that Titanic which claimed to be unsinkable. On the deck, the lights are bright, and the music is still playing. The stock market is still hitting new highs, and tech moguls are still on stage boasting about how AI will bring us eternal life. Everyone is drinking champagne, the atmosphere is great, and no one believes there will be a problem with this ship. But at the bottom of the ship, in the engine room of this behemoth, some gauges have already maxed out, and red lights are flashing wildly. The U.S. national debt is not just 35 trillion. It has soared to 38 trillion and is surging ahead at a rate of 1 trillion every 100 days. If you divide this debt, every American, yes, including babies just born in the hospital, has over $110,000 of debt hanging over their heads. It is like an iceberg beneath the surface, massive, silent, and deadly. At this moment, if you observe closely, you will find that some people are missing from the dance floor. Those are the central bank governors, the family offices with centuries of history, and the keen-smelling old money. They didn't scream, they didn't create panic, and they didn't ruin the party atmosphere. They simply quietly put down their champagne glasses, put on their coats, and silently walked toward the lifeboat area. Their lifeboats are gold and silver. They aren't betting that the ship will definitely sink. No one wants the ship to sink. The water is cold, and who wouldn't want to keep dancing? They are just ensuring that, in case the ship sinks, they have a ticket in their hand, rather than struggling in the freezing water. So, when the music finally stops, where will you be? Will you still be spinning on the dance floor due to inertia, asking with a blank face, "What happened?" Or will you already be sitting in a lifeboat, watching the tilting giant ship from afar? Don't let this moment become the regret of the rest of your life. If this video sends a chill down your spine, then that's right. Fear is the instinct for survival. Like, share, and wake up those around you who are still pretending to sleep. See you next time.